Welcome to Escaping the Grind, everyone. My name is Sully and I am your host. Today is a solo episode. It's part of my weekly case study series where I take a scenario and I walk through the steps on how to figure out freedom numbers and compare and contrast it against a Geo Arbitrage alternative. Today is going to be Toronto and Bangkok, kind of an interesting case scenario. For those of you who don't know me or haven't heard the podcast before, my name is Sully. I achieved financial independence in March 2025. I've been slow traveling ever since. I'm actually doing this podcast from Medellin, Colombia right now, where I'm currently situated, and I'll be continuing my slow travel journeys and podcasting along the way. I usually get a lot of people asking me how I did this. How did you achieve financial independence? I usually just say, let's meet up for a coffee. I walk them through kind of the basic steps. We usually jot things down or scribble on the back of a napkin. And so this is a way of putting it into a bit of a presentation format so that it can be shared with a wider group. So I don't have to have a million coffees. And so it's easy to follow. And there's some tools I've embedded into this that you can take and play with. A lot of this is mostly a math and planning problem, but you don't know it until you kind of pull your head out and zoom out. And so I hope this will illuminate how this could potentially work for you. I'm going to share my screen so you can follow along. Bear with me. There we go. And so I've dubbed this 4 simple steps to plan your escape. And so this is all super complicated stuff, and that's probably why a lot of people don't dive into it and don't develop plans and maybe are adrift without knowing how much longer they have to work or what things they can change in their lives to improve their lives, but also their financial situation to give them more options. So let's get going here. So of course, a disclaimer, this is for education and information purposes only, not professional advice. The content is not legal, financial, or tax advice. Consult a professional like a CPA or a CFP before making any major decisions. And I'm using some tools, mayretire.com and Numbeo. These are just projections based on the data within those platforms. Individual results may vary. And the goal here is that, you might just want to start playing with these tools to give you a sense of where you are and eventually consult one of these professionals and just be more prepared and fluent and proficient in this material so you can actually have a more productive conversation with these professionals. Once you have your own plans, you can check it against theirs or ask better questions. Okay, so what are the steps? 4 simple steps. The first one is determine your true costs. Like, what are the costs you need to survive? What is your burn rate? Second is calculate your freedom number. What is that? What's the number you need to be able to stop working or transition out of full-time work? And then the time to freedom. How much time will it take? The third step is forecast drawdown scenarios, and that's using the mayretire.com tool. And then the fourth is, just to spice things up, is analyze a Geo Arbitrage scenario that might be of interest to you. Hopefully the one today is. Data needed. So this is the data you'll probably want to collect before you undertake this process. You'll want to know your total income, total expenses, your liquid assets, so stocks, bonds, etc., that can be liquidated easily. You could also include rentals if you want as well. The tool can accommodate this. Total CPP estimate of what you would get, and old age security. These are both for Canada specific. And then pension estimates, if you have a pension, of course. So our scenario today is a couple based in Toronto, David, 53-year-old senior project manager, and Elena, 52, a marketing director. They're in Toronto, Ontario. They're feeling burnt out by high costs and commutes. Their gross income is $195,000 per year Canadian. They spend about $6,200 a month or $75,000 per year. Of that, they can usually save, if they're judicious, about $5,200 or about $62,000 per year. And they've been working in Canada for 30 plus years. Explains why they're burnt out from high costs and commutes. This is what their budget looks like in Toronto. It's about $6,200 per month. The rent is quite high. Toronto's a high cost city. We are just using rentals for ease of comparison, but if you were to have a paid off house, you could just put the cost to maintain it. That wouldn't reflect your opportunity cost, of course, of having all that equity tied up, but it facilitates this analysis. Utilities, $365, car and transport, $306. Now this could be a lot higher in Toronto. This could be like $800 or $900 if they're both operating cars. We're just putting $305. We're assuming they're taking public transit at this time. Groceries, $910. Dining out once per week, $600 per month. Health and fitness, $250. Leisure, $450, and personal care and help, $300. So a grand total of $6,200-ish per month. And so we'll spice it up with some geo arbitrage. Why would we add geo arbitrage? This is especially relevant if you are interested in living in another country, and not just because it's cheaper, but perhaps because it's an interesting life experience. Why is it, of course, beneficial? It brings down costs significantly, depending, of course, on the location. It can accelerate freedom numbers exponentially. It can really speed them up, as you'll see in this analysis. It can level up your quality of life. Escaping winter comes to mind, or a big commute. But it also increases the complexity of your finances and your residency status. And so just a little caveat there, careful analysis of residency status is essential. I was actually trying to get my buddy Adam Parker, who does a lot of this work in Thailand, but he's not available. So we might actually run this in 3 months and have him lean in and share, or chime in and share insights on these residency pieces for Thailand. So we've added in a Thai budget of similar kind of standard. It's total $3,200, so just close to half of what it would cost in Toronto. Most things are half or less, except for health. And that's because you're going to have to purchase a private healthcare plan, and those tend to get more expensive as you age. So that's why I highlighted it. Everything else is considerably more affordable. You can, of course, play with this. You can dial it up or down. This is just the input that's going to go into calculating your freedom number. But keep that in mind. It's about half the price. And these are two global cities. I think that's important to remember. Actually, Bangkok is trending quite a bit. There's a lot of people moving there, because not just because it's affordable, but because it's this bustling, diverse metropolis with just a lot to offer, or on offer. Okay, so this is step 2, calculating our financial freedom number. So do you even know how many assets you have, and how are they growing, and then what they can produce? Well, this is the process to do that. There's a rule called the rule of 25. It's a simple formula that determines your freedom number. You're basically multiplying your annual expenses, what we just went through, by 25. And once you have that number, that's the amount you actually need to resign if you want. But that is connected to this 4% rule of thumb. I put in brackets. It's a guideline. Basically, it's taking that total annual amount times 25, and then the framework basically says you can withdraw 4% of that total number every year for 30 years without running out of money. And that's based on Bill Bengen's research. It assumes that you have investments in low-cost, broad-based index funds. It's not based on you picking stocks or buying crypto. This is based on a broad balanced fund, 60% equities, 40% bonds. There's a ton of research out there on this. There's a ton of discussion and debate. I encourage you to go check it out, but we're just going to take this rule of thumb for our step 2 here to get us that number. So in Toronto, it's just under 1.9 million, and in Bangkok, it's just under 1 million. Bill Bengen, by the way, is the author of that research. It's widely accepted and used as a bit of a benchmark or standard for calculating how much you can withdraw. It's this 4% safe withdrawal rule of thumb. You can dig way, way, way deeper, and I invite you to do that, but we're just going to move on for now and assume we're going to use this to just get us our plan. So case study, here's a quick summary again. David and Elena in Toronto, just under 200K in gross salary, and they can save about $5,200 per month. And they've worked in Canada for 30 plus years. So we also need to collect their assets, do a bit of an inventory. So here are all their assets. So everything from RSP, which is tax deferred, to TFSAs, which is tax-free growth after those dollars have been taxed already, and then non-registered, basically taxable. Everything that all the income, dividends, or capital gains are taxable. So their total investment liquid net worth is $827,000. That's a great base. It's actually pretty close to the Bangkok freedom number already, which is interesting. So then the other thing we need to do is we need to have an estimate of their CPP, their Canada Pension Plan, and their old age security. So CPP is based on contributions. We're just making an assumption here that they've contributed the full amount for 30 years. So they're entitled to $11.56 each per month, which is great. So we're going to use that estimate. You can actually call Service Canada and they will give you an estimate. You can even say, look, I'm going to stop working next year, and they will give you the most accurate estimate. CPP has COLA. It has inflation adjustments with Canada's CPI. And then we also need to estimate old age security, which is based on residency. So it's out of 40 years living in Canada over the age of 18, prorated. So as long as you've lived 20 years plus in Canada, you can still collect this while you're living abroad, even if you stop working in Canada, as I just mentioned. And so the estimate for David is 35 years, and that's about $649 per month. And for Elena, 34 years, just under that, $630. So we need these numbers to input them into the withdrawal strategy tool, mayretire.com, which we'll get to in a second. Okay, so we know there's a gap. We know they need more than $827,000 for both scenarios, so we need to bridge the gap. So we know they can save $5,200 per month. What does that mean in terms of how many years their gap between freedom number and where they are? We're going to use this handy compound interest calculator. There's lots out there. I'm just using this one because it was easy to use. It's on rebeldonegans.com. And you basically input the total net worth and at the time of what we're trying to forecast, monthly investments. We're going to put in monthly investments. They can put in $5,200 per month, and we're going to say that it grows at 8% per year. And then, so we're just setting 30-year trajectory. So you can quickly see how quickly they would get to these different amounts. So for Toronto, they would get there, it's about 1.8 million. They would arrive there at 7 or 6 years. And for the Bangkok one, they would achieve that in about a year's time. So we'll go back to our PowerPoint, and we see here that yes, actually this should be 7 to 8 years. I think I was using a different calculator when I did that, but it's quite the contrast. Less than 2 years, let's just say 9 to 10 years here, give or take, depends on the markets. That gives you your bridging the gap time frame. And then we're going to move over to projection tool called mayretire.com. What I like about this is it's a visualization tool. It gives you a better line of sight on your freedom date. So you can click on it. It's free. There's many tools out there. Some are not free, some are. This one's really simple, and it has great features for community conversation. So they have a Reddit, they have a Facebook page, they allow you to upload your plan into ChatGPT and ask it questions on how to optimize things. So that's why I like using it. You can check it out. It's free. And of course, this is a DIY approach. You'll want to get something more in depth at some point. You'll need to reach out to a fee-only financial advisor. These are the better ones. These are the ones that you pay up front, but they don't have a vested interest in what you're investing in, and they're not taking any cuts from your investments. So definitely go with a fee-only financial advisor if you get to that point where you want more certainty. Maybe you're in the last year, or maybe you're 5 years away. Who knows? Up to you how confident you feel, but this is just going to give you a framework to at least get line of sight on where you are and how long it might take you to get there, and how to kind of play with your portfolio and assets to prepare for your freedom time and to get better outcomes. Okay, so we're going to go to May Retire, and I'll show you. I've pre-populated these to make this easier and shorter for all of us. So this is the first scenario. First, I'll draw your attention up to the right-hand corner. And so these are features that I just mentioned. So you could actually click here and open a ChatGPT conversation. Let's see, it's taking its time. You can also compare plans. You can download 2 or 3 scenarios and upload them and do a comparative analysis. This is where you download the JSON files to do that. You can download a PDF, and then these are the community pages, Facebook and May Retire subreddit. Here's the ChatGPT. Once you upload your JSON, you can have a conversation about your plan and actually ask questions on how to play with the tool to get better outcomes. But for our purpose today, I've pre-filled this out. So they're in Ontario. I'm just saying they're retired just to show us how we draw down once they hit their number. You put the age in. I put the plan ending at age 95. They're a couple. And then I put the CPP numbers that we estimated here. You don't need to worry about all these other presets too much. You can ask ChatGPT about it. We're just looking to do a quick ballpark of this. The assets, the TFSA RSPs have been entered. There's a RSP withdrawal strategy, which we'll get into. It's one of the cool features. I always put enable TFSA funding. So every year you put more into that TFSA because you get more room, depending on how well your plan is funded. You can play with asset allocation. You can keep it simple and just use what I think the financial planning community in Canada uses as a baseline, or you can set asset allocation for your accounts, depending on how you're investing. You can set the bond amount, the different sectors, US, international, emerging markets, etc., so on and so forth. And I kind of just leave it there. I've inputted the 75,000 that they need to live on in Toronto. So you would first just do a quick calculate, and it would calculate. It says the plan is funded until 71, so not fully funded. It doesn't go to 95, so that's problematic. And what I love about this platform is it gives you these great data sets or visualizations. And so this is where you can see the gap is, right? Once you hit 72, you have a gap in that funding level. So of course, if you're contributing that amount that we calculated before, this will be solved if they stay in Toronto and save all their money for 8 or 9 years. This would be very different, and we would adjust those numbers accordingly. If we go to the Bangkok one, it's the same inputs, except the amount they need to live that same quality of life, and it's probably actually a better quality of life in Bangkok for the most part, for half the price. So I've inputted the target annual income they need at just under 40K. Everything else here is the same. And then we calculate, and you can see I've already done this. It says your plan is fully funded, and there's going to be there's a likelihood that they'll be in a state of 4.4 million. Wow. So even if they were to stop working and not doing one more year of savings, the plan still works. I would probably do another year or two just to have a buffer. But again, you can kind of look here at these different where you're pulling that income from which account. So you can see the RSP, you're pulling quite a bit here at the front end, the red. It is showing that you would be eligible for GIS, but because you need to be living in Canada for GIS, if this is the Bangkok scenario, you probably wouldn't be able to count on this, so you can kind of omit that. Another section that's great is just the projected balance of your net worth over time. So you could probably spend a bit more earlier to upgrade your quality of life, because it's showing there's a strong likelihood that you'll have a big estate. So if you don't have kids, you probably want to play with this tool and withdraw more earlier. There is a tax, an average tax chart here, which I like. So you can see your average tax in those first few years is actually a bit higher. It's about 12%. That's because you're withdrawing more RSP, which is tax-like income. So you could play with that, and maybe we'll show you that in a second. And then, of course, there's all the data in a spreadsheet, and you can download this and actually play with it. But this would be kind of your plan. If in year one, you would know where you're withdrawing your money from. So we can go back up. We'll just do a few little tweaks. Again, this is in the Bangkok one. You could, if you don't want to go to Bangkok and you want to be in Toronto, you would play with the other one. But here's what you could do. So you know you're going to have a big estate. So instead of having a constant dollar withdrawal rate, you could do a flexible one. And so in your lowest amount is 38,000 a year, let's say. But when the market has really good years, let's say you want to go to 50K. Let's put that in and see what happens. And so you put that in, and now you do a simulation. And when it simulates, it looks at all the historical stock market history, and it simulates what would happen if you had retired and just lived off your portfolio on specific dates. So I believe it's called a Monte Carlo. This is really cool because it gives you different confidence levels and gives you a sense of what the middle of the pack is, probably what you'll end up at, and probabilities. So you can see it's doing the simulation. So wow, your retirement income is secure with a confidence of 100. Most people are pretty happy with 95% confidence. So this is telling you could probably spend quite a bit more. There's a great dashboard here that tells you the likelihood of things. So there's almost a 60% likelihood you'll have a very large end portfolio. So do you want to upgrade your spending a little earlier? Why not? This gives you some of those different Monte Carlo scenario outcomes. So the best scenario, you could end up with 5.2 million, and the worst, 634K, probably somewhere more in the middle of the pack. But gives you that sense. And you notice that we did set a flexible rate. So in this one, you'll see that it's a flexible withdrawal rate. So there's going to be years where you're withdrawing way more. Like here, you're withdrawing 90K, right? Total, the target is 38 to 50, but it's withdrawing way more. It looks like those are years where there was good market returns. You see that your projected account balance is more even. It's not this kind of singular upward curve, I guess. So this is good. This is a better balanced approach. You can play with that. Your taxes are still higher here. You want to maybe smooth them out like peanut butter on a piece of toast. So we could probably go up and do that. You would go, I think the big culprit is the RRSP. So we could play with the strategy for RRSP. We can do a custom strategy, and you can chat with ChatGPT about this. So here's one, 9 to 15K. Let's adjust that. Let's do 8K to 14K, no tax limit. Save that. And let's see if this changes how much we're being taxed and if we're pushing some of that taxable income further down, spreading it across. Okay, simulation complete. Still very high. Let's go down to the tax one to see if we move the needle on it. Okay, you can see actually the RSP is being taken across the entire life cycle. That's interesting. The projected balance is different. Of course, every time you simulate, it's a different outcome. And let's look at the tax. So the tax went down quite a bit here, but it went up over here over time. So maybe that RSP withdrawal strategy is still a little too aggressive. I'll just change it one more time. I won't dwell on this one, but let's just bring it down a couple here. Let's see how this changes the tax scenario. And because it's at 100% confidence level, let's increase this to 55 and see, maybe 56, and see if this changes the confidence level by a lot and improves the tax situation. Bear with us as it simulates. So every simulation is also going to be different than the last. It's simulating these different outcomes. Okay, 99%. So you could probably afford to increase that income a bit more. Again, this dashboard is really useful. OAS clawbacks. See, your portfolio isn't going to be as large as it used to. That's good. If you don't want to leave an estate, of course. You can always check the total taxes you and your spouse would pay. That's pretty good over an entire retirement life cycle. This is looking pretty good. Let's go down and look at the projected estate. So see, it's actually really good. Your total portfolio is getting smaller and smaller, so you don't leave a huge estate. That means you're enjoying your investments and your savings earlier on when life allows you to enjoy them more. And then it looks like the tax still peaks up later on. You can probably fix that by playing with the RSP or a different drawdown scenario. But I'm not going to go into that level of detail. I wanted to just show you some of the levers here. The RSP is one. increasing income with a flexible strategy that adapts to market volatility is another. But yeah, it's quite powerful. If you had a pension, you could add it here. If you have rental income, you can add it in as well. But for today's simple ballpark scenario, I think that's good. Of course, if you were to, save for a couple more years, the 5,200 that they can, you'd need to adjust these numbers in these different accounts and the CPP. But for today's purpose, we're just doing these ballpark runs, so you can look at this tool, understand the confidence levels, the dashboards, potential different outcomes, where you're drawing things down from, the amount of tax you're paying, the different amount of income you're drawing down on average, from what accounts. This is really useful when you start to draw down. What's accumulating, what will be left over, and then the tax. There are other charts you can look at here. I think there's too much. I think these are the ones that I like to use the most to help me with planning. The last thing you want to do is over accumulate and not enjoy those resources, and it ends up going to probate to the government or something to that effect. So with that being said, great tool. Play with it. You can download a JSON. I believe this is how you do it. You download that, and then you have that to upload into ChatGPT, and you can start to ask it questions. Tell me how to optimize the tax, or help me improve how much income I'm drawing down every year, so on and so forth. So I'll leave you with that free tool, great tool. Hope that helps you get that ballpark. So back to our deck. Considerations, we went through some of them. You can always generate side hustle income too. Just keep that in mind. So if you live a salary job, maybe you're doing consulting, maybe you're teaching English if you're in Bangkok, who knows? It doesn't mean you can't generate more income. There's this $100/30K rule. Basically, for every $100 you save per month, your portfolio you need 30,000 less in your portfolio to generate that monthly income we discussed. Here's a quick table. Or if you generate an extra 100, it's like having an extra 30K in your portfolio, because you don't need to have 30K generating that $100. And from 500 to 1,000, it just shows you how it impacts your saving. Again, math problem. It's basically, you dial it up or you dial it down. When you go abroad to a more affordable country, you get to dial some of that down. You shouldn't let the tax tail wag the dog. Sometimes we try to over optimize, but it might get in the way of actually enjoying the money. So figuring out what is the threshold, what is acceptable, and then moving on and enjoying your investments. And if you're doing Geo Arbitrage, that experience. Striking a balance between optimization and lifestyle maximization. You can go either way on the spectrum. Try to stay in the middle. And flexible withdrawal strategies do enable better overall lifestyle. So when times are good, you can really upgrade your life, as we saw in some of those simulations, but just have a baseline amount that is comfortable enough for you to weather market downturns if you don't have a pension or inflation adjustment pension or government benefit. I created this for the series when we do a Geo Arbitrage location, just some risk spectrum considerations or categories. So fixed cost, pretty good in Thailand, high value modern condos, lower utilities in Toronto. So that's optimal. Lifestyle, you upgrade your life, world-class food, dining, hotels. It's a global travel hub, so that's pretty good. Health and fitness, you have access to excellent healthcare, high-end gyms, so on and so forth. Tax load, it's kind of a murky one. It can be good, it can be bad. They keep changing the tax code. You got to be careful how much of your finances you bring in. Again, that goes back to that conversation about residency and being domiciled, where and what tax exposure you have. Malaysia, for instance, will be a green because it's a territorial tax system. So that's an important consideration. Environmental risk, moderate. This might even be a red. Pollution can be quite bad in Thailand. They have burning season, and the PMI levels can be quite bad. Sometimes it's like smoking a pack of cigarettes a day or something to that effect. Weather and climate, depending whether you like the heat, it can be really hot and humid compared to the last location that I covered, which was Medellin, which is temperate and spring-like. Especially as you age, high heat and humidity can be an issue. Visa and residency, moderate. They have lots of visa programs, and they're relatively straightforward, but all of them, you're basically a glorified tourist that gets to stay longer. You don't have any pathway to permanency or civil rights like you would in most Latin American countries or even Europe. Safety, very good, especially if you compare it to Colombia. Very low violent crime, very safe, even safer statistically than Toronto. Socially and culturally moderate. There's a lot of expats, but unless you speak Thai, it's very hard to integrate, and Thai is not an easy language. It's also, culturally, you'll never be Thai, quote unquote. So there's that barrier to full integration. So I put that at moderate. I'd be curious to hear your thoughts on some of these, especially if you've lived in Thailand. Reflection. So buying back time, you can lower a target from 1.8 million to just under 1 million. You recover about 10 years of your life if you just keep grinding it out in Toronto and commutes. Quality of life, you upgrade it. Aside from the pollution and the heat in Bangkok, you can really upgrade your life to a thriving mode. Health and wellness, you're transitioning to a leisure-centric lifestyle. You won't be grinding. You'll be exploring Bangkok and the regional travel destinations in Thailand. I think that's an upgrade. You'll probably be more active, no commutes. And then your financial independence ratio is achieved much faster because you have lower living costs. So you can stop grinding much sooner, or you might try to grind up to get more income. So you don't have to do that if you do the Geo Arbitrage scenario. So to recap, 4 simple steps: determine your true costs. And this is a math problem, but it's also a lifestyle decision-making challenge. If you don't want to cut some things, you're just going to need to work longer. That's what it means. If you do want to make decisions and maybe cut some things that aren't essential, you might accelerate to this freedom number. I have no bias towards either or. It's just facts, right? It's math. Calculating freedom number and time to freedom. We did that through the 25 times your annual income and then using the 4% withdrawal rule of thumb. And then forecasting what drawdowns do through the May Retire tool. And then lastly, you can take a location across the world that you might be interested in and see if that accelerates your path to freedom. My caveat here is don't just go for a quote unquote affordable country. Do it because you're actually interested in living in an interesting place and having a cultural transition or experience, rather than just focusing on the dollars and cents, because it might not work out if it's just about affordability. And with that, I will end it here. What did you think about this? Would you stay in Toronto, grind it out, have a bigger cushion? Would you leave immediately with that plan, or work a couple more years, build the nest egg? What are any gaps in this idea or plan? Curious to hear your thoughts. Thank you for connecting with us and watching this. You know what to do. Like, subscribe, and let us know if there's another destination you want us to cover in the next case scenario series. Thanks so much for tuning in. Until next time.